Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, welcome back to the Wade Borth Podcast. Man, I'm so excited about this conversation because one thing I love to do is bring clarity to a subject that has a lot of misconceptions. I think if somebody would say, hey, Wade, what is it you do? If I had to boil it down to one thing, it's bringing clarity to conversations that truly impact people. And again, my job is to guide you down. And again, maybe it's not even guide you down. It's empower you to take control of your financial future and to achieve your goals and provide you the proper resources, other people that can help you through that process. So again, where this comes into play is like, I love being able to empower people to find that freedom, that clarity, that joy that they're looking for in their finances and relieve that financial pressure that most people feel. And so we do that through education, awareness, education, and implementation are really the steps that we look at. So it's super important that you kind of like, where does this fall in the line? Is this about education? Is this about awareness? And sometimes awareness leads to education. Sometimes education leads to awareness. So I'm not saying which one comes first, but I would say once you have that, then it's like, what is the implementation? What's the action I can take to make that happen? So part of the awareness, part of the education today we're going to touch on is this idea of mutual insurance companies and dividends. So this is a very broad topic that most people will never get into because it just, if you're an insurance geek that's been in the business 35 plus years like I have, this becomes very exciting. So I'm going to try to make this subject exciting for you from the sense that you have the ability to understand what something is and how it can fit into your life. Then it becomes exciting when you understand how it can relieve that financial pressure and how it can solve those problems or those hurdles that are in your way. So let's take this journey down this lane. Let's walk together in this conversation because I think it's really important that this conversation is understood so you can make a better, more informed decision. So let's start with mutual insurance companies. Why do we use mutual insurance companies? Why is that the only thing that we use is mutual insurance companies? Well, the biggest reason why we love mutual insurance companies is because they are ran for the benefit of their policyholders. So let me just say that again. What is a mutual insurance company? It is a life insurance company. Again, we just deal in life insurance. There's mutual property and casualty, but we're life insurance. So the mutual life insurance companies are ran for the benefit of their policyholders. And this is really how insurance started back, 200 plus years ago. We had mutual aid societies. That's really how it started. So we don't need to go into the full history, but just understand that what happens was we gathered like-minded individuals, you, me, everybody that's like, we're thinking in the same way, we're like-minded. We want to get into contract with each other. Well, it was easy when there's 10, 15, 20, 30 of us. But when all of a sudden now we got thousands and hundreds of thousands of people together, let's form a company. Let's form a mutual insurance company. And it's ran for your benefit. So what's one of the reasons? This is as simple as this. Most people have a connotation like, oh, life insurance companies, they'll take you to the cleaners. They just want your money. They don't want to pay out a death claim. That is exactly the opposite of what mutual insurance companies do. So if you think about this, and I've used this analogy before, and I heard this, like most things I've heard, just by being around in the industry, think about the time of death. Now, we've all experienced this. I'd imagine we've all experienced this in some form or another. Grandpa, parents, brothers, sisters, siblings. I don't know your particular situation for the people listening, but I'm going to speak for myself. When somebody dies, most of the financial industry, what do? They try to reach out and grab as much of the pie as they possibly can. So just imagine me wrapping my arms around all your finances. And this is the typical money management people, right? They want to control, they want to keep as much as they can at the time of death so they can continue to charge a fee. And they're going to say, well, you don't need to take the money out, or, now's not the right time. And again, it's just generalization, but I'm just saying that's kind of the natural behavior of any industry, is to wrap their arms around as much of your money as possible. What does an insurance company do? Think about this. Now, this visual is me pushing out to you. They're pushing out the benefits to you because that's what the contract was for. Somebody dies, and it is designed to provide you with cash, with liquidity, dollars, money, whatever you want to call it. And that's the purpose. And that's the difference between the rest of the financial industry and life insurance. They push money out where everybody's trying to round it up, pull it back to them. Now, let's break that apart a little bit. There's stock companies, which are owned by Wall Street, and there's mutual companies, which are owned by the policyholders. And I've heard this before. The companies are out there, the insurance companies are out there just to stick it to the policyholders. Think about the logic there. If the insurance company, if the mutual insurance company sticks it to their policyholders, what do they have to do? It's more profit to them, right? And profitability by law, by contract, has to go back to the policyholders. So there's no incentive for them to quote unquote stick it to the policyholders, because again, they have to return that extra profit back to the people that hold policies. So it's like it would be just a circular argument going back and around where it doesn't make any sense. Now let's go over to the stock companies. Are they doing this? I don't know that they're doing this, but just from a mental exercise, just walk me through this. Is there incentive for them to increase their profitability? Absolutely. Because who owns them? Who benefits from them sticking it to you? Somebody on Wall Street or somebody that owns the shares in the stock of that particular company. So let's just think about that again. Who do you want to do business with? Do you want to do business with your company, or do you want to be a customer of somebody else's company? Do you want to be the owner of a company, or do you want to be a customer of a company? I would prefer to be the owner. You seem to get treated a little bit better when you're the owner of the company. That's why we use mutual companies. Now, with that being said, and because of that, they offer what's called dividends. And so dividends are just a return of excess premium. So what they're saying is like they make certain assumptions, because again, they live in the I know world, not the I think world. So actuaries, there's an actuarial science to it. It's a whole business model that they need to pay claims. Honestly, we're writing policies today that claims aren't going to be paid for 100 years from now. That's when a death claim is going to be paid on some of these things we're writing today. So just think about the mindset between just that. We have to be around 100 years from now to pay that claim. That's how mutual companies think. They don't think, the next quarterly conference call like a stock or any stock company would do. I mean, we hear about it all the time. You turn on CNBC and it's like, well, here's the quarterly conference calls, the quarterly earnings seasons. It's all quarter to quarter. That's how they live their lives. Insurance companies really think, what's the next quarter century look like? Think about how your mindset changes when you start to think, what's the next quarter century look like? Now, they live in today's world, but they're making decisions that have to be a long-term impact. They can't make it up, because their stock price goes up. They have to make decisions. That's why we use whole life insurance. That's the reason why we use properly structured whole life insurance from a mutual insurance carrier. Because it brings us the certainty that we need. It brings us the clarity that we desire. And it gives us the freedom and the sense of control that we need in our lives with our savings dollars to take advantage of other opportunities. That's the reason why we use mutual insurance companies over everybody else. And so, the question always comes like, oh, the IUL versus the whole life. I'm like, it's not a question to me, because again, the whole life is the only product because of the structure of the company that can do and say what it's going to do at the very minimum. I know with certainty what the exit strategy on my policy looks like 30 years from now. Think about how empowering that is. You know what your exit strategy is 10 years from now, 20 years, 30 years from now is. You know with certainty what that is at the very minimum. Now, could it be better? Yep, it could obviously be better. Will it be better? Maybe so. More than likely, it's going to be better than what the very minimum is going to be. But that's the beauty of when you know what the baseline is, and the only way it's going to go is up, then there's nothing but upside in there. Then it becomes a lot more clear. It brings you that safety and security that you're looking for. So people say, well, I got these other life insurance products. They're permanent products. Yeah, they're permanent products as long as nothing comes up that's detrimental to the product, right? Because there's a lot of uncertainty in those things, and we can get into that other discussion. But what I want to kind of focus back on is this is why we use mutual insurance carriers over stock carriers, because it brings us a level of certainty that nobody else can provide. And so when we talk with clients, it's like, we live in this I know world of savings, and we have all the 8 benefits. We've had this in another podcast, all the benefits come with it, but the biggest benefit is the guarantee and the certainty. So then when you need that money, it's going to be there. So then you can go ahead and make decisions versus I think the money's going to be there. So therefore, boom, maybe we can take advantage of this opportunity, maybe not. So it is that clarity that is so valuable to us through a mutual carrier. So I'll bring this around because I intend to talk a little bit about dividends and difference between dividends and an interest that you're earning with a stock company. So just remember, a stock company is owned by Wall Street and a mutual company is owned by its policyholders. Because I've heard this too, is that stock companies are, they're getting a higher yield, or they're getting a higher interest rate, or they're investing a lot of commercial property or single family residence, just all the noise that's going on there. So let's talk about that real quick, because this is really important. So think about this. Who owns these stock insurance companies? If we look who the ownership is lately, it is venture capitalists. These venture capitalists are in there to make a quick dollar. They move into insurance companies because they see a lot of money flowing through these things. So they're forcing these companies to make decisions that maybe aren't great long-term decisions, but they're great short-term decisions. How does that impact your policy? Well, just think about it. They control all the levers about what they charge and what they allow you to credit and all the things that are going on there. So they're forcing decisions because they're looking at the next quarterly earnings call. Mutual companies, they still have that long-term focus, next quarter century. Just think about it that way. And so they're saying, hey, we invested money, we've done better than what we thought, we had less mortality, so therefore we return that money in the form of dividends because they're taking all the risk. And if they have better return than what they expected, they're getting rewarded for managing their risk, because what they do, then they're returning that to you in the form of dividends. Now, some companies will have a guaranteed rate smaller, higher. There's some really small pieces too that we can talk about, but just know that it starts with, why do I want to work with a mutual carrier? It's because it's ran for your benefit, where the other one is ran for the benefit of some venture capitalist that's out on Wall Street saying, I X amount of return in the next year and a half, or in other words, I'm not going to put, $100 billion with this company. So they okay, we'll capitulate. We'll take and change our thought process. A little scary to me. I think it is long-term in this industry. It's very scary to me, just from my observations, just because you've seen a lot of stuff kind of come and go over 35 years. So I'm just looking at this like this is the next wave that is going to bring a lot of uncertainty to those people that don't have or don't do business with a great mutual insurance carrier. So this is the difference between earning a dividend, which is just, hey, we assumed it was going to be X. It was, our experience is much better than that. So therefore we're returning back to you dollars that we didn't need. So thank you so much for using those dollars. And we're going to put it back in your policy as cash value. That's what a dividend is in a mutual carrier. Over the stock company, they're going to say, hey, we're going to base this on the best case scenario, which is today's assumptions. And if they don't work out, hey, you're just going to have to put more money in. So it's two different approaches. One approach is the stock company with the IULs. Again, I'm not saying they're good or bad. I'm just saying awareness just takes it from today's perspective. What's the best case scenario, which is what we know today. That's the only thing we can bank on. Is like, that's the best case scenario. And if it doesn't meet that, it's going to force you to put in more dollars in the future. Or it's going to lapse your coverage, or it's going to reduce your coverage. There's a lot of things can happen there. But it's never very good for you because we're starting from the best case scenario. Mutual insurance companies, they actually approach it from hey, what's the worst case scenario? And let's build a product from that. And if it's better than that, we return it to you because by contract and by law, we have to. So if you want to boil it down, that's just the two different ways that you look at dividend paying whole life insurance versus other life insurance contracts that are out there, permanent life insurance contracts that are out there. Again, no right or wrong, good or bad, they're just tools. And if you don't know and understand how to use the tools, they become very dangerous. That's all I'm saying is become aware of ownership, and what's the motivation behind all that. Again, if you want to have a conversation with me about, the contract you're looking at, the contract you have, your existing whole life coverage, my goal, my objective is to bring clarity and certainty and education to you, awareness education, and then say, what do we do with that and how do we take action? That's really what my motivation is. So reach out to me. Listen, go out and read some of the content that we have in our blog post on sagewellstrategy.com. Book an appointment with me. Call me. Let's schedule some time together to have a thoughtful conversation about, is the product that you are thinking about buying or have purchased in the past serving your needs and serving your purpose? And I think that's really what it comes down to. Having an understanding, a thoughtful conversation about how it's actually serving your purpose. So again, thank you for listening. I appreciate going down this little bit of a rabbit hole with me because it's important.
because it's the understanding of what you're buying with dollars for over a lifetime. I mean, you're spending some serious money on these things. You should have great education and great clarity about where you're going. That's my job, is to help you, empower you, not to do it for you, but to empower you so you know where you're going and then allow you to take some action afterwards. So again, thank you so much for your time. Reach out to us and let's have a deeper conversation about you in particular. Thank you.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.